Good evening, just between appointments tonight, thought I might do a video, been a bit slack lately. This morning I made a post on Facebook, don't know how many of you saw it, but it was about an investment property company sort of advertising that they had a client receive $15,000 tax return based on their investment property losses. I just want to discuss a bit, talk a bit about the fundamentals of how the tax returns work, and there's a bit of misconception, I believe. A lot of people think, you spend money on your work expenses and you just get that back. You spend $1 on a pencil that you need for work, you get that $1 back. So what happens is when with your deductions, if you spend, let's start with you earn $100,000. If you then spent $40,000 on things for work, so if you're entitled to claim vehicle expenses, travel expenses, public transport, parking, uniform washing. Then if you've got an investment property, you've got your negative gearing, but you've got your interest expenses, you have depreciation, you have bills, rates, water use, all that sort of thing. All those things you can claim for tax. What happens though is you don't actually claim those dollar for dollar. What they do is the total of those expenses reduces your earnings. So if you earn $100,000, you have expenses of $40,000, your taxable income then drops to $60,000. So you don't get $40,000 back, you just have to pay tax on $60,000 rather than $100,000. In that instance, your tax on $100,000 is $26,000 a year. Tax on a $60,000 income per year is about $11,000. So you'd get a $15,000 tax return in that instance. So it's not the dollar you spend, it's the amount you reduce your income to that you then pay tax on that then gives you your return. It sort of ties in as well with the negative gearing and the positive gearing argument. A lot of people, about 12 months ago, there was really intense arguments about negative gearing needing to be scrapped, and a lot of people that still to this day believe negative gearing is one of the greatest things since sliced bread, especially in the investing world. Negative gearing, I believe, is a really great policy. I think it allows a lot of people to buy investment properties, and I do think it is something that's worthwhile. Maybe it needs to be limited to a certain amount of properties per person, but look, that's up to people that write policy and law and things. But if you were to go negative gearing or positive gearing, you had a choice. If you made $100 on your property, so after all your expenses, rent, you still had an extra $100 from rent that you didn't need to spend, and your tax rate was 30%, you have to pay $30 in tax. So your overall gain is $70. If you were to negative gear $100 though and your tax rate was 30%, you would only get back $30 and your net loss is $70. So when you negative gear, you lose 70, but if you would positive gear, you make 70. So I just think it's a really slight misconception that people are really interested in negative gearing. If you have the option, positive gearing in the long run is where it's at. But obviously, talk to your accountant, financial planner. Depending on your situation, certain circumstances might dictate that one gearing strategy is better than the other. That's it for today. Thanks.